Hi everyone, it's Christian from Serene Education. Going to be doing the four majors analysis update for the second week of September, so the 6th through to the 11th of September 2015. Going to be looking at the four majors. Let's start with the euro against US dollar on a weekly, just to see how last week panned out and what we could have in store going into the second week. So after non-farm payroll, let's have a look and see what the markets actually show us. So let's just zoom in here so we can see what's happened. The end of August gave us this exhaustion candle at a resistance level. Now, clearly this level over here, this candle over here, if you look at it in conjunction where it is, you'll notice that going back over 2015, this has clearly been a resistance level of price. So looking at 2015 alone, you can see resistance here in January, start of Feb, resistance yet again in April, resistance yet again in June, and yet again resistance going into June, July, August of this year. So we should have seen some sort of pullback. We did see a pullback. Notice that the candlestick itself, the end of August, the weekly candle actually closed higher than the 20-period moving average. So that happened to be a support level of price. Okay, so what we wanted to see was obviously price making new lows, exhaustion candle, and then we could look potentially back towards these levels over here, which will be the July low, and ultimately back towards the March-April low, which is here in 2015. So clearly we have a number of targets for the foreseeable future. Exhaustion, notice that the candlesticks on the weekly are still predominantly red. So even though price is consolidated, we're not seeing any new lows recently, the overall bias is still one of negativity. So you'll see the 20 and the 50-period moving average are pretty much heading in the direction. You'll see that price over the end of August giving us this exhaustion candle. So now we want to see long-term sentiment, selling with long-term sentiment. So here again, what we need to see is price making new lows. But as you clearly can see, the 20-period moving average has acted as support. And last week we saw a lot of indecision. We saw euro making some highs, but ultimately moving back to the downside yet again by the close of play on Friday after mixed results. Well, non-farm payroll coming out weaker than expected. We saw non-farm payroll dropping from 245 the prior month to an expected 215, which came out even worse than that at 173,000. So creating less jobs in August, not a good sign. Ultimately, having said that, we saw some other positive figures like unemployment continue to drop, which is fantastic. We've seen a continual drop of unemployment since 2010, in fact, where unemployment was at its almost all-time high in 2010 at 10%. Now we are on the 5.1. So clearly over the last, 5 years, we've seen almost a 5% drop, which is fantastic. So as long as that continues, good sign for the US dollar. We've also seen average earnings, hourly, month-to-month figures rising, which is good because that means there's a lot of capital within the system. Employers and paying their employees a bit more, i.e. bonuses, etc., which is a good sign. So an increase of expected of 0.2 came in at 0.3, so 0.1 of a difference, which is good. We're heading in the same direction. As I mentioned, non-farm payroll was the one. Less jobs created, but it wasn't because less jobs created. It was more people going out of work in August. So yeah, not a genuine reflection on overall negative, not making new jobs. There's just a lot more people were actually leaving employment through the August month. So still US dollar strength to a degree on price action. So euro should still see negativity, or US dollar should gain a bit of strength against most of its crosses. So looking at the week ahead, we would need to see price making new lows. And you can see that if I just pan in here quickly, we do need to see that 20-period moving average price remaining below that level. So I'm just going to go ahead and draw the fib levels on here. There we go. I've got the monthly pivots on. So clearly you can see that price is trading below the monthly pivot here. And you can see monthly pivot S1 is exactly where I drew that green horizontal line before. And funny enough, monthly S2 is not too far off from those lows, the 2015 lows. So we can get rid of those two lines, in fact, because clearly The pivot levels are indicating where our vital targets are likely to be. What we want to see then is, if I go ahead and draw the weekly pivots, we should see a weekly pivot in and around this area. So I've gone ahead and applied the weekly pivot. So straight away, you'll see that both the, apologies, wrong one over here. Both the monthly and the weekly pivot are above price. There we go. So what I tend to do is I'll shade that area in, so I know that the overall bias is still one of negativity, because as long as price is trading below the monthly pivot, perfect should be looking for selling opportunity or bearish sentiment. If it's below the weekly pivot, there again also another confirmation of negativity in the market. So therefore I should be looking low. You'll notice that there's a first pivot actually here, which is the weekly pivot. So where price is trading right now to that level, we're looking in excess of 135 pips. So looking into the next week, we want to just drop down to the daily. We need to see price making new lows to see further negativity creeping in, because we know the overall bias from the prior week or the last of August was a negative candle. We had a major support and resistance level, prices pulled back. We've seen that. Notice on the daily, however, we have a confluence of all the moving averages. And the most importantly, the institution moving average and the 50-period moving average below price, still supporting her. On the daily, you can still see that the candlesticks are blue. Okay, and as long as it maintains above the institution moving average, the overall bias is still going to be to the upside. You'll notice that price has not made any new lows recently. We've seen swing highs, swing high, swing high, swing high, and price is at that level right now. But we've seen negativity over the last 2 weeks, in fact. So to see any further selling with long-term sentiment, we would need to see this 200-period moving average being breached, as well as a 50, and then we can aggressively target the weekly S1 before looking towards our most important one, which is the June-July, which is the monthly S1 and weekly S2 level. So that constitutes a very strong support and resistance level, which means that'll be a viable long-term aggressive target. So you're looking at 184 pips on average below that level, but we would need to see Monday, Tuesday, Wednesday, Thursday, Friday of the following week, the new week, closing low to give us that bias indication. You can see here we do have a red arrow, but the candlesticks still remain blue on the daily, which is not a good sign. Okay, they need to be red, and then we can get a genuine opportunity to sell with long-term sentiment. Okay, so as long as price remains above the institution moving average on the daily, there's less likely for genuine selling to come into the market. So vitally important, wait, be patient, look for a nice bearish engulfing candle close on the daily, get below that institution moving average, and we should see further genuine selling with long-term sentiment. Let's move on to sterling. Here again, let's look at this indicator box over here. Totally different compared to its euro US dollar counterpart. You can see here in euro we're seeing a bit of a mixed bag over here on the indicator box. If you look at sterling, a lot cleaner, and over here it just shouts out sell, 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 sell. And if you look at last week's candle, pretty much gives you that indication, and we should have been, and I mentioned it in my analysis last week, we should have been looking for selling opportunities this week. Why? Because last week's candle, sorry, the week before's candle has actually engulfed almost 5 weeks of consolidation, ranging, okay, at a major support and resistance level, which happened to be the 200-period moving average. So we should have been looking for selling sentiment last week. Therefore, look towards a downside, and effectively around this level here where we saw this morning star formation, or the 20-period moving average, as a vital first target. And that's clearly what's played out. And last week alone, if you just shorted on this bearish engulfing candle, there was almost 285 pips in total to be made from this particular pair to the downside. So candlesticks, vitally important, do give us a heads up. And I'm just going to apply the monthly pivots now onto this to give us a signal looking for further opportunities to the downside. Because this particular chart, sterling is screaming sells, because clearly over 2015 prices pulled back. But yet again, almost like its European counterpart, the euro against US dollar, prices failed at the institution moving average. Not once, but on 3 separate occasions. And the longer she battles to get above an institution moving average, the more bearish sentiment comes in. Because if price is not going anywhere, people are going to start getting a bit irritating. In this case, price didn't go anywhere at all for almost 2 full months. You're not making money, so people are just getting out of it. And the economics have actually given us that data, and subsequently we've seen a fall from grace for sterling. So I'm just going to apply the monthly pivot. There you have it. You can see the monthly pivot is above price, so therefore negativity. You can see all my moving average above price, which is a negative sign. The RMO, the OSM is clearly below, clearly telling us we should be looking for selling opportunities. So therefore, we should be looking ahead to see if there's any major support and resistance levels. You can clearly see where the monthly S1 level is, where price is trading right now, is where price actually closed at the end of last night's Friday's night's close. But we can see S2 and the S3 level, which happens to be the major support and resistance level for 2015 below us. So we know now vitally where price could fall to over the next month or so. 145 pips to monthly S2 level, and between the monthly S2 to the S3 we've got another 314. So loads of space for further selling opportunities for this particular pair. And if I drop down to the daily time frame, you can clearly see now we're below the institution, which is a good sign. So 200 period moving average above price on weekly and the monthly, and now the daily also. You can see that clearly we've been moving sideways. No real momentum over the past couple of months. That's now been taken away as price is closed below and headed down to the downside. So now we should be looking for further selling opportunities. Look at the monthly S1 is above price. So looking at the daily now, you can see price is closed below it on Friday, which is a good sign. So this monthly S1 level for the following week needs to remain above price and to remain as resistance. We might see a slight pullback on Monday, Tuesday, Wednesday, but as long as price stays below the monthly S1 level, we should be looking towards that S2 level to the downside. I'm just going to apply the weekly support, sorry, the weekly pivots for the following week. So there you have it. So you can see that the monthly pivots and the weekly pivots are above price. Here again, like I showed you on the euro against US dollar, if both those pivot levels are above price, it's just conforming or re-emphasizing the negativity on this particular setup. And the indicator box is pretty much telling me that anyway. The fact that we trading below the daily institution moving average is clearly another sign of that. And you can see we have a red arrow, the candlesticks are red, RMO is below, and the OSM is clearly below. So here you can clearly see we should be looking to the downside. The weekly S1 and the monthly S1 are thereabouts, closing almost on top of each other. But you'll see that in the next particular target, the weekly S2 and the monthly S2 are very much near each other as well. So here, looking at opportunities for the following week, we can see that between the monthly S1 and the weekly S2 is clearly a clear spot. Okay, there's nothing over here to impede price, so that would be a viable target or profit. So between these 2 points, we could look in excess of 144 pips. So here again for sterling next week, look to see if there's any bearish bias to the downside that could actually further continue sterling negativity, or look for US dollar strength to push price to the downside. So have a look and see if there's any major news out next week that could actually have a play on sterling further selling. We have manufacturing production month-to-month figures. We have trade balance figures, which are expected to be negative for sterling, which is not a really good sign. We also have the official interest rate announcement next week. We also got the asset purchasing facility that we expect no change, because it hasn't changed for a number of years, and I don't think it would actually change anytime soon. So manufacturing is going to be the next big one for sterling, as well as the trade balance figures. Manufacturing is expected to be unchanged at 0.2%. We would want to see that growing. We don't want that to be actually hesitating. So vitally important that we see manufacturing increasing. If we see a negative figure or lower than 0.2 come Wednesday of next week, that would actually add more negativity to sterling against a strong US dollar, and then we could look towards those lows as they actually play it out on the charts in front of us. Let's move on to US dollar Swiss franc. Here again, if euro is heading to the downside, expect the US dollar Swiss franc to head to the upside. Not last week's candle, the prior week's candle, we actually saw a hammer formation, bearish, and then we didn't see any further lows. We've seen the institution moving average acting as support for price over the last number of months. In fact, you can see the bias over here on the indicator box, predominantly monthly, weekly, and daily heading, painting a positive picture, but you can see a lot of negativity creeping in. And if you look at this particular pair over 2015, it's pretty much been trading to the we had a major correction in January, but price, the US dollar, has been trying ever so hard to try and break that January high. It's failed to on a number of occasions. Over the last month or so, we've actually seen a further hesitation. But having said that, last week we saw US dollar strength coming back into the market, and price is likely to head towards that 98.45 change sometime this month for September. So here again, look for positive bias coming into the next week. Look for strength on the US dollar, or look for negativity on the Swiss franc for next week in particular. So I'm going to go ahead here and just apply the monthly pivot. There you have it. So you can see price is trading above the monthly pivot, which is a good sign for strength. We can see the moving average all below price, and most importantly, the institution. Vitally important, the institution moving average has to be below price on each time frame to give us a bullish bias if we are looking for US dollar strength against the Swiss franc. So here you can see last week very much taking on what we had left off the prior week and moving hard to the upside. So now we can see that the monthly the monthly R1 level, which is our next level here, is approximately where price closed to that level is in excess of 233 pips away. And then you can see that the monthly S2 level is the January or December highs we've seen through 2015, which is there again from where price is trading right now to that level in excess of 540 odd pips away. So I'm just going to apply the weekly pivots just to see where those pivots actually lie on the chart for this new week. There you have it. So now you can see here again, as we saw with the first two charts, you can see both my monthly pivot and my weekly pivot are below price in this case, supporting price. Perfect. So therefore, we should be looking to the upside. You can see that the weekly pivot price actually headed to that level last week and has come unstuck. So vitally, if we are to see any further buying opportunities for the US dollar against the Swiss franc, we would need to see this 97734 level being breached sometime for the start of the new week, and therefore we could start looking towards these levels around here where the weekly R2 level actually concurs quite nicely with the monthly R1 level. Okay, and between those 2 points, you're looking in excess of 1,500 pips. Sorry, 150 pips. Apologies. So there's money to be made. There are pips to be made on this particular chart. We just need to see a breach of this weekly S1 level. Apologies, to then give us a viable target to the upside. Any aggressive traders for the new week would potentially look at trading aggressively towards that the weekly R1 level, but ideally more risk is on the table because of the fact that we're actually at that level right now. Where price is trading right now to that level is 62 odd pips away, but the risk becomes a major issue because we're trading quite close to that level. You can see on the daily, you can see all our moving averages are below price, including the institution, which is vitally important. You'll notice that on our daily, what we don't have, however, is that blue arrow. Okay, the last arrow we actually have, which is way back here, and which is still red. So daily all looking good. We need to see that weekly R1 level being breached, ideally. So I'd rather stand back, be more passive, wait for a nice bullish engulfing counter close on Monday, Tuesday, Wednesday, Thursday, Friday of next week to give us a genuine recontinuation of upside bullishness for this particular pair. And then we have a viable target, which is that weekly R2 level. So here, be patient, give a day back to the market. Okay, vitally important. Otherwise, if we don't, you can see that we've had hesitation here in the past. We could be seeing further hesitation because of the intermediate trend, and we could see price moving back to the downside again. So here we don't want to get stuck trading price action if she's not really moving with sentiment. So here, rather just give a full day to the market to give you a better return going forward. Last pair of the day, US dollar, Japanese yen. Let's have a look and see how she panned out last week. 2 weeks prior, we saw a we saw a massive candle in itself, almost 598 pips of range. Having said that, you'll notice that, and I mentioned it on the prior week, price actually failed. Even though bullish buyers came back into the market at the end of that week, price fell to close higher than the 20-pair moving average. And if you look at the weekly time frame, the 20-pair moving average over the last couple of months has acted as a viable support of price. So now when price actually closed low in that level, it's telling us that psychologically there's more sellers in the room. And yes, we did see the bullish sentiment coming back into the end of the prior week, but it failed to close above it, that 20-pair moving average. So it still told us that there was still a lot more negativity in place. So therefore, we should have been looking for potential continuations of negativity to the downside. The only scenario that would actually paint a positive picture over here is if Monday, Tuesday, Wednesday, Thursday, Friday of last week, we actually saw the US dollar closing higher than the 20 period moving average to start with, around that 122.36 and change, and then moving to the upside. That failed to materialize, and vitally, as the week played out last week, we saw US dollar negativity coming in, which then pushed price to the downside, and we had a viable target, which is the 50 period moving average in this case, but also a major support and resistance level in the past, which happened to be the March and April support and resistance level lows, which is here at 118.466 and change. And we saw price actually dropping almost 290 odd pips to the downside just for last week alone. So I'm just going to go ahead and just apply my monthly pivots to this chart just to see where the monthly pivot actually stands in relation to price itself. There you have it. You can see the monthly pivot is above price, so that's negativity. You can see the monthly pivot here. The monthly indication on this particular setup, the template, the matrix, if you like to call it, is predominantly blue, but you can see the MACD is red over here. And if we are trading trends, then we expect to see the MACD being blue. Remember, positive trends. Notice that price has failed to make any new highs over the last 2 months. In fact, May, June, July. So almost 4 months, in fact, price has failed to make new highs and subsequently has been ranging. There we go. Okay, clearly ranging between these 2 points. We saw a bearish engulfing counter close lower than the 20 period moving average, so telling us there was more bearish sentiment in place, so we should have been looking for selling. We did see that 2 weeks ago, and then we are seeing a continuation of that last week, and we should continue to see selling as long as price remains below that monthly pivot. I'm going to apply the weekly pivot now. There you have it. You can see that the weekly pivot is also above price, so therefore we should be looking for further selling opportunities for this particular pair for the foreseeable future. As long as price trades below the weekly and monthly pivot, we should be looking for further selling opportunities on this particular pair. And if you look at the intraday scenario, we'll go down to the smaller time frames, you can see there's a lot of negativity creeping into this particular pair, and the R squared is happy with that negativity. So here again, looking for further trades for the following week. Let's just drop down to the daily. There you have it. You can see that Friday's close actually closed lower than the weekly pivot, which happened to be a 3-day support. So there again, a good sign. We should be looking for negativity. We can see that our weekly S1 level is below price. That would be our viable first target, which is 137 pips away. And then the monthly S1 level, which makes it 253 pips in total away from where price is trading right now. Red arrow, candlesticks are red. The institution moving average, the 20 and the 50, are all above price, which is a negative sign. So therefore, negativity. Look for selling. Okay, RMO below. The OSM is clearly below. And the daily close on Friday has given us a bright red indicator on here, so we should be looking for further selling opportunities for the second week of September 2015. There we go, guys. The 4 majors completed for the following week. Hope it made sense. If you are interested in this particular product or what we teach, please get hold of us on the email address at the end of this video. Otherwise, hope to see the rest of you guys on the forum for the following week. Hope you have a fantastic trading week, and most importantly, trade serenely.